Hello everyone, today's video is all about changes that are coming into the UK stock market and particularly the listing rules. Now these are announced by the FCA, the Financial Conduct Authority, this week with a basic overview of trying to make it more encouraging for fast growing tech firms to list in London as opposed to say New York, where there is less red tape, makes it easier generally to list in the States than it is in London. So FCA said, look, we want to try and counter that and make it more appealing for companies to raise capital on the markets in the UK. So the narrative from the FCA, let's see what they said. They said their proposals respond to the changing nature of companies coming to the market. They aim to broaden investor access to companies in higher growth sectors by improving flexibility and accessibility in the listing regime as a gateway to the UK's main public markets. So that was the press release. The FCA said that bringing more companies to the market in an earlier stage in their life cycle would improve their access to funding and mean more opportunities for investors to share in the return of those companies as they grow. So interesting that they say bringing companies to the market earlier in their life cycle. However, it's a bit of a contradiction in terms of one of the things that they've announced, which I'll come on to. Now, in terms of the proposals, what have they said? So the main thing is the introduction of this dual class share structure to encourage innovative, often founder-led companies to list sooner. Now, what that basically means is that at the moment, when you have different classes of shares, the voting rights typically are set out pro rata to those number of shares. So let's say you've got a tech entrepreneur, floats the business on the stock market, and let's say the tech entrepreneur that founded the business has 10% of the equity and the public has 90%. Then at the moment, they would have 10% of the votes. Now, they're saying that's not how you want to encourage these tech guys to come to the market, because they'll just go elsewhere where those restrictions are not in place because of the existence of the so-called dual share class. So when you have dual share class, that pro rata vote goes out the window and it can be multiple times more than the pro rata. So take that same example. Let's say you've got the tech guy, founded the business, he's got 10% of the shares, 10% of the votes, but actually with a dual class share structure, yes, he may have 10% of the equity, but he could have 80% or 90% of the votes. In other words, continue to run the company as he wants, do what he wants. And that's what's coming in. That is the change that has been proposed. So you can have the situation now going forward that these tech entrepreneurs can have this dual class structure, which enables them to have much more heavy weighting towards the voting rights. In other words, they can keep doing what they were doing, which a lot of people would be happy with because that's what they're buying into. Essentially, it's the personality of often the founder to keep driving the business forward and making the money. So this is deemed to be acceptable now, where for decades it wasn't, and it's what you need to encourage these tech geniuses to list on London, because quite frankly, the FTSE 100 is a pretty stale index. A lot of multi-conglomerate companies, very old, not very exciting, racy tech stocks, and they want to try and encourage more of these tech stocks. Hence, dual class share structure, where the founder can maintain control and have more of a say, like they did before they went public. So that's the first thing. That's quite a big deal. The dual class structure. So the second proposal that the FCA announced was reducing the free float requirement. So the free float requirement basically means the percentage of the shares in the company that are available in circulation to the general public. And the rules, as they stand, is that 25% of the shares of these companies have to be in the free float offered to the public, and that will be reduced down to 10%. So again, the reason for that is it lowers potential barriers for issuers. So tech geniuses, entrepreneurs want to hang on to maybe quite a big percentage of their stock, not just say the voting rights, but in terms of, they don't have to list the entire company, and the percentage that of the overall business that has to be available to the public, that is come down from 25% to 10%. So that's proposal number 2. Now then, number 3, bit of a controversial one. The third proposal is to increase the minimum market capitalization threshold from 700,000 to 50 million. Why? To ensure greater trust and clarity about a company's listing. Now that's kind of goes against one of the reasons for bringing in these proposals in the first place, which they said they want to encourage companies to have access to the market sooner. So a lot of these big companies, obviously, they all start off small and then they grow. But all of a sudden you're saying, okay, the minimum size that they have to be before they can list on these public markets has all of a sudden gone up from 700 grand to 50 million. But yet that flies in the face of the other statement that you want to encourage these businesses to access public funds sooner. So it's a bit of a counterintuitive proposal that actually that the FCA would want to increase that requirement. So basically, at the minute, if you've got your business is worth £750,000, in theory, you can float on the stock market. Now, it probably cost you half that just in fees alone. So the cost benefit wouldn't be so great. But in theory, that's how the rules work. If your business is not even worth £1 million, you can float it on the stock market. Now, that figure is going up to 50 million. I would suggest that is probably too high. I think there would be a lot of startup businesses, exciting tech companies coming back to this tech. It obviously doesn't have to be tech, but they tend to be where the fast growth is. And I would say that they've probably pitched that too high, 50 million. A lot of successful companies, trending in the right direction and growing fast with, a lot less market cap, shouldn't be denied the opportunity of raising finance in the public markets. Even 10 million, that's a fifth of what they're proposing. I think that would have been a better move. Anyway, but it's gone up to 50 million. So that's the third proposal from the FCA, and then the fourth proposal is simplifying the FCA's rule books to reflect changes in technology and market practices. But that's basically admin, really. But no, the three main ones though are the dual class structures, and reducing the free float, and then this minimum market capitalization requirement. So I can see how the first two would certainly encourage these tech entrepreneurs to list. The third one, I'm not so sure. Maybe that's too high a minimum 50 million. But anyway, let's see what happens. So that's just an overview there on the UK regulators' proposals to sharpen up the UK listing requirements, predominantly with a view to encouraging more tech firms to list in London as opposed to elsewhere in the world, like on the NASDAQ or some of these special purpose acquisition companies, these blank check companies that float with nothing in them, just cash, and then they go and buy existing companies. They're all the rage in the States, or they have been the last sort of 18 months. It's kind of because at the end of the day, it's competition. London stock markets are in competition with stock markets around the world. Yes, they're quite high up there. There's, the Nikkei, the NASDAQ, Japan, America, not many others ahead of London. Certainly London is the number one market in Europe. But they are, losing out because it's competitive. They are losing out on having companies list because of their archaic, decades-old rules that stifle these entrepreneur innovation situations. So that is why the changes are afoot, and they have been announced this week. So let's see how that transpires. Let's see which types of businesses do indeed list in London over the coming months and years. So if you like this video, please do subscribe right there, and I'll see you soon.